Right, then I think we'll make a start, John, if that's okay.
Yeah, that's fine.
So we want to put this content on. We've had a number of corporate transactions, if you like, within the MAP client base in the last couple of years, and that could be anything from our clients acquiring other businesses, merging with other businesses, selling their businesses, attracting private equity investment, even things like refinancing, financing of the business for the first time. And we sort of came up with a banner of corporate governance, which probably doesn't do it justice, but struggle to find a better term for it, really. But this is an area that John and myself are really passionate about. We've worked with Bermans on a number of deals and a number of clients during their lifetime and their relationship as well. And what I would say is that this is not just good governance if you're looking to sell your business. It absolutely is needed if you're looking to sell your business or do a corporate transaction. But this is just what it says on the tin. It's governance. It's making sure that your business leaves no stone unturned and you're organized so that you don't come to regret it later. And come to regret it later could be, expensive legal fees, undue stress, up against timelines, and even scupper a deal if these things are not in place. So it's great for so many of you to have come on today, and the earlier you get this stuff in place, the better. It doesn't all have to be expensive. You don't have to pay advisors to do all of it either. But obviously having the right advisors and having the right people around you so that they're available when you do need to reach out and you do need that support is good governance in itself as well. So John's going to take us through some of the legal aspects of good governance, and then I'm going to finish off on the financial, and then we're going to make an invitation to you at the end in terms of if you are interested in exploring next steps with this, then there's a way to do that. Okay, John, do you want to take us away?
Hi, everyone. If you don't know me, I'm Managing Director and Head of Corporate at Bermans, and been doing that for more time than I care to remember. But so I'll try and keep this sort of pretty succinct. But in effect, corporate governance is just making sure you've got the right sort of legal building blocks in place to assist the business from a commercial perspective, but just to make your life a lot easier if you're ever going to raise finance or you're going out for tender for larger customers and all that sort of stuff. So, the good news is it's never too late to put these procedures in place, whether you start up, you're going through a growth phase, or you're more than 5-10 years old. So I think as a sort of a visual example, I use the sort of the Strawman example. In that the head is the directors and the share structures and the shareholders agreement, in effect the board and the majority shareholders, and you've got the heart, which is the beating heart of the business, which is the employees and how you lock those in. And we all know what a competitive landscape it is at the moment, and the pressure on salaries and bonuses and ways of locking in people from a different perspective by using equity share capital, and then your arms are your suppliers, your client terms, your intellectual property, and all that sort of good stuff, and data, which is massive. I'm sure you've come across the headaches of GDPR, which is just only going to get more and more involved as the world opens up. And then Paul's section there, and Paul will be sort of fitting into what I do as well. We've probably got a couple of examples, but then Paul will sort of major on the financial aspects of corporate governance, which in effect gives you a really good platform for growth. As Paul said, it doesn't have to be expensive. If you start and you have a dedicated person within the business, and you look at this on a regular basis, it's great, it's efficient, and it improves your business and ultimately your profitability. So that's the sort of the Strawman example. So if we go on to the share structure, which is obviously the ownership of the business, you'll know that shares are issued, shareholders change, especially if you're a high growth business, you start up and you issue shares to a whole raft of people. Sometimes especially if you're short of cash, if you're a technology business, you can see that shares are offered to developers and shares are transferred when people leave in the early stages. Now, what I find with more early stage businesses is that you come to company's house And if you ever need to look at your share structure, which generally is if you're taking on finance or a new shareholder's coming in, or you may just ask your accountants or lawyers to review, the reality of the share structure in Companies House don't match. And that's pretty problematic in the fact that that's the first port of call that basically any large supplier or customer may look at, or in effect an investor or a bank. So at a very early stage, what you should do is make sure your lawyers and your accountants and yourselves make sure that absolutely reflects the reality. In that if you've, a shareholder's left, the stock transfers are done, or if you've issued new shares or took on investment, that's reflected in your company books and on Companies House. Now, the error that we see again and again and again when we're going into investment and sales or just doing reviews is share buybacks. So just make sure that, if someone is leaving the business or you're in effect cancelling shares, and shout out, guys, now if you don't know what a share buyback is, but essentially that is the company buying back shares and cancelling them, in the fact that the shareholders don't have to use their own monies, they can use company funds, which is great because you're then not using taxed income, you're using funds from the business. But there's a litany of errors that can happen there, and I won't go into them in detail because that's a whole webinar in itself. But essentially, if you do that wrong and it's void, you have a phantom shareholder that you thought that had gone, that is still there. So you can imagine if you come into sale or you come into taking equity, and that is found by the lawyers ultimately, there's serious issues there. And rather than looking at all this on a sort of biannual basis to make sure it's all in order, you're left scrabbling around, paying large legal bills, dealing with tax and accountants when you're trying to concentrate on your day job and running the business. So that for me is, a really big area, and it's dead easy to check on a biannual basis that you've done it correctly. In particular, the trigger point on that should be if anyone's leaving or coming into the business, ring your lawyers and your accountants and they'll make sure it's all above board.
I think, John, as well, often the reason why that's not taken care of properly is because the essence of a share buyback is usually something's gone wrong. Not always, but somebody's exiting a business, and therefore it's a stressful time. You're trying to do the deal, you're trying to, get beyond it. And sometimes the paperwork doesn't all tally. And you might assume that it's all been done right because you've used an accountant or you've used a lawyer at the time. But one of the things that during due diligence you always get asked for is the concept of statutory books, which John referenced there. Very few small businesses, although they are responsible to do so, actually maintain statutory books now, because it used to be a hard copy thing that sits in your office. Now, some businesses now don't have hard copy anything, so everything's online and they don't have an office. This is something that can and should be done digitally, but because it's done digitally, it's very easy to overlook it. And the statutory books basically list out who are all the shareholders, who are all the directors, what are their addresses, the company registered office, but also the changes over the year. So they provide a timeline that Companies House doesn't provide. So often we'll see businesses go through due diligence process, ask for the statutory records and say, well, it's all on Companies House. But a buyer, a particular sophisticated buyer who's using a lawyer won't accept that. They want you to provide them with the statutory registers, one, because you're obliged to anyway, and two, because that actually pieces together the story that Companies House doesn't do very well.
And further on that, Paul, there's no register of ownership of shares, unlike the HMR land registry that shows you've registered a house. The actual prima facie proof, to use a legal phrase, of ownership is the shares are written in the statutory book. So, if you can't produce that timeline, and it's simple when you start, but you need to keep a track of that as you go through the growth cycle. You've got a real problem about proving ownership. So it's really important. And Matt, you have electronic templates for that anyway, don't you? So it's not a difficult job.
Yeah, we basically use Companies House as a starting point, but then it's about filling in all the pieces around it. Like you say, John, the Companies House bit is actually the after event. That's recording what's happened within the business.
Just a notice, it's not a legal document. Yeah,
you need to transact it within the business and keep it in your statutory register. So we have a way of doing that. And again, very cost effective, but you can take a view on whether you leave that until a transaction is about to happen or whether you do it during the lifetime of the business. Obviously, I would urge you to do the latter, because you are obliged to, you should be doing that anyway. But it also just gives you that peace of mind that, you know, you've done all the T's and I's. So
yeah.
Okay, bro, let's move on. Sorry about sirens.
No problem. Yeah. So, and then I guess the next stage is just making sure that the founders and the management that really drive the value of the business and the directors just basically have a very clean and workable set of shareholders agreement articles that really need to be reviewed. Obviously, if someone's coming or leaving, but basically are probably on a yearly basis if nothing changes. Now, ultimately, all these documents should be is an insurance policy if there is a fallout or if someone leaves, and you should just, put it into a drawer and forget about it. But, they need to be reviewed, and particularly, if you see a shareholders agreement and articles, the reams and reams of pages that are quite difficult to understand, in particular the articles. But for owner managed businesses, my mantra is that equity, the value of the business, should follow management and the people that are contributing significantly to the growth of that business. So it's really, really important that those equity documents, which is shareholders agreement and articles combined, deal with the scenario if someone leaves. That is by far the most important part, and that's the good and the bad leaver provisions. And a simple example, which I always use, is that you start off, there's 2 or 3 founders. It's going really, really well. There's a fallout, or someone wants to leave the business. And they simply just resign and are no longer adding value to the business. Now, at that stage, and I've had many examples here, if you can't get those shares back easily, you're held to ransom, and you're driving the value, the 2 remaining shareholders, and you've got someone that's not involved in the business getting value off your back. So you can have very simple terms that ensures that doesn't happen. And if you don't, spend the time and frankly the money with the lawyers to get those clauses very, very succinctly defined, it can cost a lot of money and strife in the future. So that narrows those quite long documents down very quickly. And of course, in the digital and creative sector, which is very similar to law, it's highly competitive and you're a people business, so you need to be careful of restrictive covenants, and these are much stronger in a shareholders agreement than in an employment contract. So because they've got equity and they may receive a value, a restrictive covenant in your shareholders agreement is much easier to enforce than in just an employment contract. And obviously that's an issue is with lawyers. People can leave and take major contracts with them. So they're the main areas in the shareholders agreement. But as with the share structure, it's just part of your business review every quarter or every 6 months. Has the share structure changed? Has someone come in? Have some shares been transferred from husband to wife, or into a discretionary trust or something like that? And as long as you've got that checklist for your quarterly board, then it's dead easy. If there's an issue, you can just ring the lawyers or the accountants and they can help you.
Yeah, there's just so many hiccups, isn't there, John? Obviously, we saw one recently where it appeared at face value like everything had been dealt with properly, but the people that had signed the document, too many people had signed the document, I think, in one situation, which obviously is not something that you would expect to be a problem, but it was. So it's literally, don't take for granted that everything's been done right. Get somebody to provide.
Yeah, it's the classic case of, we want to save costs on this. We're never going to fall out. Here's a shareholders agreement or articles that someone's used in the past, and then you sign it up thinking it's going to be okay, and it's not. I look at it as an insurance policy, and when you're running a business, no one really questions paying insurance premiums. You just pay them each year and you crack on. Shareholders agreements, the same thing, except you don't have to pay a premium every year. So, but if you don't have decent ones, you can spend thousands of pounds on lawyers and accountants and arbitration trying to unravel it.
Okay, move on to the next slide.
Great. Okay. And then we move down to the sort of the beating heart of the business, which is the employees. Making sure that which is the really people businesses, and I'll say this again and again, same with legals. You got to make sure that your key employees are not only locked in from a operational perspective and doing the best and making sure that the business is growing and assisting, but you need to review their contracts on a regular basis, and you may have standard retainers with lawyers or the likes. But as the employees become more senior, then you need to be focusing more on the key aspects of the key employment contracts. And again, it's restrictions. IP is a really important one these days. This, under common law, IP automatically vests in the company, but you need a clause in there that's very, very clear that if they're a developer, that any IP they create when working for the business vests in the business, which is really important because a lot of tech developers have side businesses that they may say they're doing in the spare time, but are they actually doing it when they're employed in your business? So you need to have that fine line and make it clear in your policies that, if you're working for us, that, the IP creates, let's be clear what that is. And this, again, I'm going back to share structure as well, where what you see when you're your early stages, you're developing IP, you may have offered shares to them. You need to make sure that that's all written, but also if you've got consultants and developers, and there's a lot of platforms that do this very cleverly now that say that, once you've paid for the IP, it's transferred, but you need to check that. If you've developed a product for one of your clients, you may actually think, well, hang on a minute, I've developed that for a customer, but we want to keep that IP and roll that out and license it to our customers. They can keep their back-end IP and the stuff that, we've done for them, but it could be very valuable. So, if you've got anything like that, obviously give us a shout. But that's something to think about. And then the sort of what you should be trying to do as a growing business is in effect making the business work without you. So you can go away on holiday, or you can do this and that, and in effect you've got a second tier management that is there in such that if you weren't in the business, it runs profitably without you. And that's really the key for growing, making your life better, and also increasing value in the business if you ever want to sell or take investment. So the key there is obviously locking in the staff. So you've got a second tier management, and we all know how competitive that is. But one of the last really tax efficient schemes that the government's really pushing now, and they relaxed the rules in the budget, which was really encouraging, is you've probably come across it, the EMI option schemes. And again, if you haven't, we can go into that in detail either with a meeting or after this quickly. But what that does is it allows you to lock in key management, and the option pools they go from 5 to 10 to 15%. But essentially what that does is it makes sure they go on the journey with you, in that you can lock them in. They have these share options, and they're not particularly shares. We mentioned growth shares, but generally what you do is you have a share option agreement, and it's only exercisable on an exit. So it means you don't have a massive pool of shareholders that you have to deal with, and they exercise the option and they hold the shares for a minute in time, and then they're sold to the third party purchaser. But they're really tax efficient. You get capital gains tax relief rather than income tax. And if you're genuinely looking to sell this business and you've got an exit timeline of 5 years, and they see the business growing each year, and you can give them worked examples of what potentially they could get if they sold, that's really powerful. Rather than going through the large bonuses and pay rise, well, you can say, well, hang on a minute, we're looking at selling in 2 or 3 years, this is what you could get. So that's really powerful, and that's a joint and legal exercise. And again, when you're looking at that gives it links back to your share structure, making sure that's healthy as well. And then the growth shares is a bit of a mix of the two. So if your business is worth 3 or 4 million now, and you want to take on a sales director to push you to the next level, you might think, well, we don't want them to participate in value from day one because they've not been here. So you can say, well, the business is worth 3 million now. We as founders take the first 3 million, and then the new sales director or whoever can share 10, 15% in the rest. And you can really cut that cloth as best you want. But they're really powerful tools to basically lock in your second tier management structure.
Yeah, just to add on the EMI, like you say, John, that is the most common one, and I think the buzzword of EMI. There are other ways of doing it as well, but just be careful. I think a lot of our clients fall into the trap of maybe opening the mouth too soon and start to make promises to people before they understand actually how the scheme works and the mechanics that need to put in place and the time that it takes to get HMRC clearance, get the EMI contracts put in place, and even just decide on the exact mechanics of the scheme. So try to get an understanding of this before you start to make promises to your team, because otherwise you could be backtracking them.
Yeah, and simplicity is key. I've seen people trying to link, the issue or granting of options to sales targets in EBITDA. I just keep it simple. You can do time vesting, i.e. number of years served, because essentially if they're not still with the company, you've probably parted ways because they're not adding value. But usually always focus on they're only really exercisable on exit, and it just keeps it really simple. But what I would also say as well is when EMIs were first used sort of 10 years ago, people were doing them in lifestyle businesses and tying people in saying, look, you've got share capital here, but there may have never been a timeline on an exit. So even if you're going to entertain it, you need to be serious about if you're going to exit or take on investment, and you need to be transparent with the team about that, because I've had a number of cases here where an EMI option scheme's been running 8 years and it runs out after 10 and all of a sudden the owner managers and the second management team saying, well, I've hung around for 5 or 6 years but nothing's happening, and that causes real friction. So again, it's really all about planning. Before you're going to offer options, obviously speak to me and Paul or whoever and properly plan for it, and then it's your comms to your team that's really important once you know exactly what you're going to do.
Yeah, absolutely. Brilliant. Okay, next one. Arms.
Yeah, the arms. So that's obviously you're going into your intellectual property there, which is you're dealing with your clients and your customers. So it's making sure, and I've touched on this, that any developers that were consultants and not employees have vested the IP in the business. Obviously, open source software is massive at the moment. You need to be careful about the use of open source software. And again, that's a seminar in itself, but there's a concept of what you call copyleft open source licenses, which is all about sharing within the community. But certain copyleft agreements say if you integrate that open source into your IP, then you need to then publish it to the market. So it's no longer potentially your proprietary IP that you may want to be selling and may have significant value. So again, you need to be very careful when you use open source. You need an open source policy. You need one of the your CTOs to understand how it's used and works. And if you do integrate it into your proprietary IP, you need to be very careful about it. So again, that's a whole subject in itself, but you do need to have a policy, and we can talk about that. And then obviously your terms and conditions in the ever-changing world of data protection and data security, really important. If you're dealing with major suppliers and customers, you'll probably have to contract on their terms, won't you? The massive businesses like Diageo and the likes, but you still need to be wary of the intellectual property clauses there and how the data works. So simplistically, if we looked at that, we won't be charging a fortune. We just home in on the really important clauses, and again, if you've got more bespoke terms, because different, even though you're in the same sector, I find that businesses are different in the way they contract with businesses. So you might have specific ones that we can help with and bespoke them, and again, review them, maybe on a biannual basis, for good corporate governance. And obviously you've got your leases, which is really straightforward. Regulatory, if you've got any dealings with the finance world, obviously they're big on regulation and data security if you specialize in that sector. So you need to make sure you cover them there. Obviously cryptocurrency is a completely different area, which I've done a lot in recently. So you're probably not involved in that, but regulation is coming thick and thin in the moment, and it touches us all. So make sure that you either outsource that, whether it's data protection, etc., and make sure you have someone internally that clearly understands it. Data processing, you would have all come across. Obviously, if data is going outside the UK and the European Union, particularly the States and the Far East, you need to be very, very, very careful, and you need to know that if you're hosting, who's hosting it, where is it, where's the data center, where is it hosted, and all that sort of good stuff that obviously your technical team needs to liaise with your data team. And if you need to bring in lawyers as well, we can help with all that good stuff as well. But again, that's I think that's it from a legal perspective, and they're the sort of the main arms and building blocks that you can look at and just build into your management pack and review on a quarterly or bi-yearly basis. But make sure you do it, and it might be a very quick review, but I assure you, as the business grows, these areas become more and more important. And if you put these building blocks in place now and just have standard procedures, it'll put you in good stead, and it'll save you a lot of hassle and cost and time in the future.
Great, thanks, John. If anyone has any questions, by the way, feel free to pop them into the Q&A so we can start to queue those up for the end when we're finished. I'll move on to legs now, so financial management, but we'll come back and have a discussion with John once I've done this bit. So most of you watching this will already be clients of MAPS. You'll have most of this in place already, depending on which services we're engaged for, and you'll actually have it nicely organized in a form of a data room in the fact that we set up Google Drive shared folders. So a lot of this stuff you're already well on the way with, which is great. Obviously, when it comes to selling a business, it reaches another level, and there's an awful lot of scrutiny on a lot of this information. And what a buyer's really looking to understand is how you've obviously got a business that's attractive and that's performing, otherwise you wouldn't have got this far in the discussions, but has it got a track record of performing? And have you got a business that is actually quite predictable? Buyers, investors don't like businesses with peaks and troughs. They like steady, predictable performance and ideally growth, and they like to see that the forecast shows continued growth in line with what's been happening in the last few years. And even if you've got periods where it's peaked and you think that's a good thing, they'll ask loads of questions to try and understand some of those trends. So statutory accounts the last 3 years seems obvious. They're available to Companies House, but they'll only be abbreviated accounts. They'll want to see a full set of accounts. Again, every year that you've filed with MAP, you'll have the full set of statutory accounts saved in Google Drive and the signed copy saved as well, which is what anyone looking into your business during a due diligence process would want to see. But if some of those years are pre-MAP, then we need to make sure that we're getting hold of those the right version of the accounts and that they are signed and dated as well, and that we just scrutinize them and prepare for any questions that might come back. They'll be looking at your management accounts. They'll be looking at your management accounts and making sure that they tie up with the statutory accounts and there's no differences between them. And if there is, they're explained. Typically, again, they'll be looking at a 3-year horizon. So 36 months, month-on-month management accounts, often plus forecast, because clearly they're only buying the future of your business. The past is the past. The past is used as an indicator of future performance, but they want to see the forecast and stress test that there's not about to be any surprises in the coming period when they're actually going to own the business as well. And again, I find myself talking about this from a buyer's lens, but that's because that's when it comes under most scrutiny. But clearly all of this stuff is what you need anyway in order to run a healthy and profitable business. So trend analysis, so that could be trends in terms of anything on your P&L, anything to do with your customer retention, customer sign-up rate, staff retention, staff churn, all of that kind of stuff, profitability by department, service area, everything that you could think of. And what we've started to do for more of our clients is started to build more trends and more reporting into their monthly management accounts pack. So if there's something that you think, I think that would be quite good to start tracking, we can start to add stuff into the monthly financial statements that we're already producing. Things like revenue and gross margin by customer. So they want to again see longevity of customers, growth in customer accounts. Are they being delivered profitably, which can be a challenge because often with an agency style business and any service business, that ties back to timesheets and seeing the time and cost of people that have been on those accounts. So can you tie all of that together? And clearly the more longevity you've got on accounts, the better. So our customers coming and going all the time, or are you signing them up and they're staying for the long term? What are they buying? Working capital analysis, really important. So debtor days, work in progress, deferred income, liabilities, how well is the business turning its profit into cash? Is it having to wait a long time for that cash to show up? Or is it a very cash generative business? So making sure that you've got reporting in place that shows how the working capital changes over time.
I mean, just to input there, that is really, really important when you're looking at refinancing or taking on equity or in selling. Just the concept of knowing what you call your normalized working capital is really, really important. And essentially that is, you know, your debtors less your creditors, and you take out the cash and you normalize it over is it 12-month period, Paul, I would say?
Typically, yeah. I mean,
Yeah.
buyers can choose their own method, but the best practice is over a 12-month period.
Yeah, and if you can sort of show that you've been doing that, you know, with MAP on a regular basis, it does look impressive, because I don't know how many businesses I've sold that are from, you know, 1 million turnover to 50 million turnover. They couldn't provide this information. So if you're doing that from day one, it does look impressive.
Yeah, and one of the things that if you're selling a business, most people are familiar with the what's called the enterprise valuation, which is usually a multiple of EBITDA. But in addition to that, to arrive at the equity value that you actually get paid, you would often expect to get paid for the excess cash in the business as well. And you'd need a working capital analysis in order to understand what that excess cash is. So we've started tracking this for some clients.
Right.
They can track what their excess cash would be if they were to sell the business today, and tracking that through the management accounts.
Yeah, which is brilliant, because it properly informs you, because that you know for personal experience, you want to know what you get in your back pocket after you've paid your tax, and it's very frustrating when you don't know that, and it takes, you know, a month or so to get that figure. So if MAP's doing that on a rolling basis, that's really, really helpful for anyone that's looking to sell or take investment. That, you know, what would I get after all the advisors have been paid, I've paid the tax, and it's actually been paid, because that's in reality what everyone wants to know. Yeah.
Balance sheet analysis. So, you know, every area of the balance sheet, being able to understand it all, being able to justify the figures that are in there, being able to provide working papers to explain each of the balances that sit in the balance sheet, and then also again how that's changed over time. So is work in progress going up and down? Are the debtor days going up and down, or are they predictable? Any buyer prefers something that's more predictable or can be explained. Payroll. So you've got lots of data and information available within BrightPay. If we're running your payroll, but there's loads more extra information that comes out in regards to not just payroll, but pensions, auto enrollment duties, and making sure that all the regulation has been followed. And also a trend analysis on payroll. So again, starters, leavers, pay rises, additional compensation. Any buyer would want to understand all of that. And then finally, tax history. So there's kind of 4 key areas of tax really that is going to be relevant for a small business, and making sure that all of that is explainable. No liabilities have been paid late. If there's any payment plans in place, they are on track and they're explained, and they are understood and presented if it's in a buying situation. But as I said, this is all about showing that you've got a business that performs period on period, and that it's a solid business that works without the owners. So shall we? I'll just take Steve's question now, because he's been waiting a little while, and then we'll come back. So if anybody's got any more questions, if you pop them in the Q&A or in the chat like Steve has, and then we'll come back to those after these next couple of slides from John. Sorry,
it's all right. We'll do that. We can do the questions, can't we?
Yeah. So Steve's question is a really good one, which is the obvious thing of, well, if these people have been incentivized under an EMI to stay with the business until sale, and then they've had a windfall, why would they hang around? And it really puts them into the same pot as the owners at that point, Steve. So the owners, 95% of the time in a service business are going to have some form of earnout, because the buyer at the end of the day have bought a business that you've built successfully, and they want it to continue being successful. So particularly in that first 12 months are key. They want a good integration plan, and they want ideally you to be around to make that as smooth as possible. They may or may not feel the same about the people in an EMI scheme, because they might have been really important getting the business to this point. But if they are a CTO and you don't need a CTO in the new business, or they're a marketing manager and marketing's going to be done by the bigger business, then they might not need that person post sale. But if they do, then that's when they'd start to get linked into the earnout that you would inevitably be tied to as well. So a completion payment and some form of earnout, and they would decide who they want to be in that earnout depending on who needs to stay around for the integration of the business.
Yeah, I mean, I get this on a regular basis. I'm doing it now, and it's if you're selling it for a lot of money, and someone gets £500,000, they might think, well, I'm not hanging around. It's a valid point, Steve, but Paul's right that some of that will be deferred. That if they leave, they will lose. But essentially, really, it's up to the buyer and the sellers to make sure they stay. Now, there's a couple of examples. If there's someone they really want to tie in, and you're concerned that even with the sale price, they might leave, then it's a new salary and bonus package, isn't it? On the other side, you've got to make sure that they're comfortable with that. So there's some of the examples. But I guess you'd know those types of people within your business, and what you'd do is you'd plan with the buyer pre-deal, and sometimes you might even, if you've got confidence in trust in that particular individual, you might bring them into the frame pre-deal, saying, look, we're doing this. You're integral to the business. This is what we want to do for you. So that's the way of doing it. And you've also, if it was a larger private equity backed entity, there might be all sorts of incentives they can offer the other side. And you never know who buys you. The person might be really enthused about the new buyer as well. So it's very hard to predict, Steve. One example that I've done recently that I'm not sure works is that you had a provision in the share option that if you leave within 12 months, you have to repay the monies. It's a bit of a disaster tax-wise for the person, because they'd have to pay their national insurance themselves, but that could be a deterrent that we've used. But I think it's case by case basis, Steve. So if you've got any questions like that, we can pick up, offline another day.
Yeah, there's a lot behind that one for sure.
Yeah,
Brill. Okay, if we've not got any other questions, we'll just do a little bit on Berman's. John, if you want to explain a bit more about Berman's.
Yeah, if you don't know us, we're sort of full service commercial law firm across Manchester and Liverpool, focused on the owner managed sector. So we all areas we do that you've probably experienced, but in particular, we've got niche national presence in banking and invoice finance, which some of you may use in your business. I focused in technology and digital and creative for the last 10 years. So I've done a lot of transactions in your space with Paul and other advisors. I also have close links with the Startup Factory in Manchester Tech Centre, assist those with their equity investment. So I've got a lot of connections in the technology space. Also, more recently, I've been involved in the Manchester Blockchain Allowance, which is all the Web3 stuff, which is a really exciting community. So if any of you are interested in that space, there's some really interesting stuff going on in Manchester at the moment. Probably, Paul, we can have a chat about that as well. But yeah, that's it. We're very straight talking lawyers, and competitive in the way we provide pricing and also the structure. But I think we give a personal and commercial service that a lot of firms don't. So happy to speak with you, any of you guys, as and when.
Great. So the invitation to proceed really is, if you're interested in getting some of this governance in place, John and myself will sit down with you free of charge and just explain what that might look like for your business. And then in that meeting, obviously, we'll be able to give a quote for any work that you might need to instruct Berman's or MAP to do on your behalf. But we'll give you effectively, a blueprint of what this good governance looks like, how you build a data room for the lifetime of the business, and up on any corporate transaction as well. So we will follow up with an email, the recording of today's webinar with the slides as well, and then with an invitation to book a meeting with myself and John if there's anything on your mind you'd like to go through, or you'd just like to look at what this looks like in terms of good governance and getting the file set up. Okay, thanks very much.
Thanks, everyone. Take care.
Thanks. Cheers. Bye.